Richard Wolff has a warning about negative interest rates that you're going to want to hear. Check this out. Leave your comments, ding the bell, share it with your friends, and subscribe to our channel. On the line with us is Professor Richard Wolff, the economist, co-founder of democracyatwork.info, author of numerous books. His most recent, The Sickness is the System, When Capitalism Fails to Save Us from Pandemics or Itself. rdwolf.com is his other website, and you can tweet him at Prof. Wolff, PROFWOLFF. And Professor Wolff, welcome back. I'm looking at this article from the Financial Times. Bonds, this is where people give money to corporations or states in exchange for interest on that money. But bonds worth $17 trillion now trade at a yield below zero, which means that if I'm buying a $100,000 bond from the state of Oregon, if it's a negative yield bond, or from Ford Motor or whatever, I'm actually paying them to take my money. I don't understand. $17 trillion worth of negative yield bond. People are, big investors or big companies or countries who's coming up with $17 trillion and why are they willing to pay somebody to hang on to the money?
Well, here's the way it works. First of all, everybody needs to understand exactly what you just said. That a negative interest rate means that you're charging people who are lending you money. Think of it as they're paying you a fee to store or to hold their money over a few weeks, months, or years. So it is a situation in which usually it starts with a central bank. Banks that have more money than they can lend out have the right to park that money with the central bank in their country. Normally, the central bank pays them, as it always did, to store that money. It's a borrower paying an interest rate for what is effectively a loan. But we have such a bad economic situation in the world. We have such a crisis ongoing, contrary to, for example, Mr. Trump's boasts about a great economy, that we don't have enough business to justify companies borrowing money and paying proper interest rates to then use that money. So the money is sitting there, not being used. The banks put it in the central bank, hoping to earn interest, but the central bank, being desperate that the economy is in such trouble, pulls a fast one. It says, okay, you can park your money with us, but we're going to charge you. It's a way of creating the incentive to the bank. Go out there and find somebody who's willing to borrow it and pay you for it, because if you leave it with us, you're going to have to pay us. It's a sign of how bad the economy is, because it's a way to force people who might otherwise have lent you the money without it being productive to instead use it in the real economy to get people to buy things or companies to make things.
So negative yielding bonds in general, broadly speaking, are an indication that government central banks are freaked out about the economy and trying to create a stimulus. Is that the kind of boiled down version of what you just said?
Right. That's right. Normally people understand that if the economy is down, one of the things central banks do is lower interest rates to make it cheaper for people to borrow in the hopes that they will and that will stimulate the economy. Well, suppose they keep lowering it and people just don't do it because the economy looks so bad that even with lower interest rates, even when you can get cheaper money, you're not going to do it and invest it in real production and real jobs because you're so down on how the economy looks. Well, you just keep that logic going, and eventually it'll get to the point of lowering the interest rate below zero with the same intent of stimulating under these conditions something which in fact has not happened enough, and between you and me, there's no prospect it's about to happen anytime soon. And part of the reason you're seeing it right now is that this resurgence of COVID, particularly here in the United States, is turning predictions of economic well-being into their opposite, and that is freaking out the Federal Reserve and other central banks.
So I believe it was 5 or 6 months ago, you and I had a conversation about negative interest rates. And you mentioned, as I recall, that there is a debate among economists about whether negative interest rates can even be effective. And if they can be effective, whether that effectiveness is limited to a very short-term period or whether they could be effective over the long term at stimulating an economy. A, is my memory correct? And if so, B, has there been any kind of consensus achieved among economists or central bankers about this? And if this doesn't work, what's plan B?
You're right about your memory. It has not worked. That's why we're in the economic difficulty that we're in again. Here's what has happened. By making money as cheap as the Federal Reserve has, and by pumping trillions of it into the economy, all that extra money available at such low, even negative interest rates, has led the banks to pump the money into the one place where people still think they can make money, and that is the stock market, which has therefore become like a casino, like an immense Ponzi scheme in which everybody is pumping money in there, buying shares in the hope that they'll find someone else who can also borrow money very cheaply to buy those shares at a higher price a few weeks, a few months down the road. So we've had this bizarre situation over the last 6 months in which the mass of the people living in the real economy are in trouble, and the tiny portion that own the bulk of the stocks are riding a stock market that goes ever further. What that tells you is that our economy is schizophrenic. It has a good stock market for the few, but a disaster for the many. And for the president to call this a great economy just shows you how unconnected all of this is from reality. And the plan B, well, at this point, with our government and most, there is no plan B. There is the vague hope that somehow Mr. Biden or whoever replaces Mr. Johnson in England or the others will now finally understand that allowing the banks to be the determiner of how all of our economic troubles are to be solved is a plan that doesn't work, and that a much more direct intervention is needed. But unfortunately, the Democratic Party and the liberals often are not that much further ahead on these financial matters than the conservatives, so I'm not terribly hopeful that anything other than a broad-based economic downturn on the edge of which we now sit could force the kinds of changes that we need.
Right. Yeah. Are we on the edge of another Great Depression here?
Right.
And if not, will a COVID vaccine bring us out of it? We have about 45 seconds. Do you expect Jerome Powell to stay as the chair of the Fed?
I certainly hope not. He has done really very little other than knee-jerk reactions to pressure from Mr. Trump. It is true that will now be gone, assuming we don't have a coup d'etat in this country, and he will now be under the pressure of Mr. Biden. But there's nothing about his performance that would make you want to keep him. So at this point, I think it's an open question. My guess is that Mr. Biden will replace him when his term is over.